Let's go right now to Michael Cuggino. He's portfolio manager for the Permanent Portfolio family of funds. The flagship Permanent Portfolio fund is ranked in the top 1% of funds in its class over the 5-year period, so beating out almost all of his peers. Michael, thanks for joining us. You have a slightly different view on things than Andrew Keen had, for example, although obviously he's trading for a much shorter term than you are investing. But you're still bullish here, even though it feels like we're in a soft patch for the economy, and stocks have been really dragging down over the last couple of weeks.
Well, we're cautiously optimistic. I mean, we manage money in a variety of different asset classes, equities being one of them, but also bonds, precious metals, commodities, both U.S. and internationally. I mean, we're cautiously optimistic that, there's the worldwide growth story we believe is still out there. We think it's a multi-year issue. The U.S. is participating in that and actually helping it along. That's where the bullishness comes from. I think it's been beneficial to the U.S. stock market. From a profit standpoint, U.S. profits were very good in Q1, a continuation of several quarters before that. Dividend yields are very favorable on equities, so investors can sort of collect the dividend and wait for multiples to expand versus getting, bond yields, which maybe don't have as much growth potential in them going forward. And there's a lot of liquidity on the sidelines for stocks going forward. So a lot of reasons to be cautiously optimistic, but make no mistake about it, there's a lot of headwinds out there as well, and the previous guest mentioned several of them.
Well, there are, and actually I want to bring in Adam Johnson here because playing defense has been better than offense lately. Adam, what do you got?
Yeah, Michael, actually, I want to share these numbers with you because the proof's in the pudding, right? Look at the returns over the past, well, I'll call it year to date, for healthcare up 14.5%, staples 9%. Versus the S&P up 6%. I mean, literally, healthcare and staples are the two best performing groups in the S&P so far this year. Their defense, so proof's in the pudding. How do you get excited about global growth and bullishness when, in fact, that's not been the place to be?
Well, I don't believe anything's fundamentally changed on the global growth story. I mean, there's been noise coming out of China that they're slowing down, they're raising interest rates. I mean, that sort of thing has happened periodically for the last several years. We still see strong worldwide demand, and I think the U.S. is part of that. No question, some of the stock rotation has been in defensive names. If you believe some of the mixed data points, maybe the U.S. economy is slowing right now. Maybe it's not. We just don't have enough data at this point to tell that. It would be natural for investors to gravitate towards more defensive and consumer names if they really do expect a slowdown. So that really doesn't excite me too much. The other thing, too, would be that after many, many months of a real great run-up in stock prices, a consolidation, profit-taking, a waiting for the next round of data points would not be at all surprising to me. So this in the short term really doesn't concern me a whole lot.
We have, though, European analysts are cutting European earnings forecasts by the most in almost 2 years, and we've talked to a lot of admittedly pessimists here in the U.S. who think that we've already sort of peaked and are at least plateauing, maybe coming down as far as earnings growth for U.S. corporations. What do you say to that? I mean, are you concerned that the big growth is behind us now?
Well, I don't know if the big growth is behind us, but certainly Europe bears watching because eventually, if business slows down in Europe, or the issues in some of the smaller countries extend to some of the major economic powers in Europe, like a Germany, then that will eventually affect U.S. growth. So this is one of those data points that bears watching and situations that bears watching and why we're not crazy bullish and cautiously optimistic.
Well, the European situation is one that we have been watching, obviously, very closely. PIMCO's Bill Gross told Bloomberg Television earlier today that Greece is the world's #1 candidate for default. Listen up.
At some point, the can cannot be kicked down the road any further. It may be sooner now rather than later. What that means, I'm not sure in terms of months or even in terms of a small amount of years. But definitely Greece is insolvent and needs funding from the FSF and a lifeline. But ultimately, I think debt holders will have to bear some of the burden as well.
So what do you think, Michael? I mean, how key is this, what goes on in Europe, to your investment strategy, to what you do? I mean, how key is, for example, the possibility of a Greek default?
Well, I mean, the real issue with Greece and their austerity measures are not working as good as hoped. And the real question for Greece, as well as the rest of Europe, is, how long are the economically stronger countries going to support the euro and the current regime that's there without the political controls that maybe we have in the States for united currency? That's the real big issue. We've been talking about Greece for the last year. So, I mean, it bears watching, but it doesn't have an immediate impact on our strategy. If you look at the world's primary areas of economic activity, the Americas, Asia, and Europe, I mean, clearly Europe is probably the weaker sister in those three. And will impact the other two, but to what degree, we're not sure yet at this point.
I do want to bring Julie in right now because pension funds are shifting assets overseas, and it's an interesting story considering what's going on. Jules?
It is. Of course, we're not just talking about Europe. We're talking about all international areas. And as we know, Asia in particular has been hot. The emerging markets have been hot. If you look at the change between the first quarter of 2005 and the fourth quarter of 2010, it's pretty remarkable. A 50% increase in where pension funds are putting their assets internationally, a drop of about 24% in the Treasury market here in the U.S., increase of 5% for corporate bonds, and a decrease of 4% for stocks. So that's sort of the mix that we have seen. Mark, I'm curious, what's your mix look like right now between international and the U.S. in the stock market? Michael, I'm sorry.
Oh, we're primarily U.S. based, although one of the screens we use in our equity selections is the percentage of revenues derived from non-U.S. sources in our U.S. companies. Our view would be that the U.S. companies on the ground in their various industries know their economies, their businesses better than we could ever do, so we would rather play them through them. In addition, it takes the currency issues off the table for a U.S. investor, and most of our investors are U.S. based, so we prefer to play internationally through U.S. companies. The interesting thing about that statistical information with the pensions coming in, though, is that, to the extent they're going emerging markets and using currencies, if the dollar does get stronger because some of those countries weaken, then those bets could go against them.
Got it. Hey, Michael, thanks so much for joining us. Really appreciate it. Michael Cuggino there from Pacific Heights Asset Management.